You know that chaotic, unpredictable crypto chart you've been watching? Well, it's not as random as you might think. Seriously. Beneath all that noise, there's a real science at play. Today, we're going to peel back the layers and show you the forces that are really moving crypto prices.
So, our guide for this journey is the book The Science of Price Discovery in Crypto Markets. We've basically taken its core ideas and broken them down into this explainer to give you a clear way of looking at this wild and, let's be honest, often misunderstood market.
And this is the big idea we really need to start with. A crypto price chart isn't just a squiggly line. It's a story. A real-time narrative of human belief, fear, and innovation, all being written by millions of people every single second. Okay, let's dive into the main concept here, price discovery. Now, this isn't some fixed calculation. It's a dynamic, constant negotiation between what someone is willing to pay and what someone else is willing to sell for. You know, every single trade is like a tiny agreement on what that asset is worth right now.
So to really understand that story, we've got to peel back the layers, kind of like an onion. We're going to look at three fundamental forces: the market's engine room, the actual code behind the coin, and the super powerful human factor.
I mean, it's the first thing everyone notices, right? Those wild swings, that extreme volatility isn't just random noise. It's the result of some really unique factors that you just don't find in traditional markets.
See, unlike a stock, a crypto asset doesn't have earnings or dividends. Its value is this really unique mix. How useful is it, how many people are using its network, and that powerful idea of digital scarcity. And this is all happening in a 24/7 global market that runs almost purely on sentiment.
All right, let's get into our first layer and see how this all builds up. We're talking about the actual plumbing of the market, because to understand price, you first have to understand where and how that price is even being made.
So this slide shows you the two parallel worlds of crypto trading. On one side, you have your centralized exchanges, or CEXs, like Coinbase. They're fast, they're user-friendly, but you have to trust them with your money. And on the other side, you've got decentralized exchanges, DEXs, like Uniswap, where you're trading directly from your own wallet. It's really a fundamental trade-off between convenience and control.
But here's the thing. Whether you're on a CX or a DEX, the single most important factor is liquidity. Just think of it like the water level in a swimming pool. If the pool is super deep, like it is for Bitcoin, a big splash won't change the water level much. But if you're in a shallow pool, like for a brand new token, even a small splash can send the price flying. That right there is low liquidity in action.
Okay, next layer. We're going even deeper now, past the trading venue and right into the asset's DNA. We're talking tokenomics, the economic rules that are literally hard-coded into a cryptocurrency that pretty much pre-program its financial destiny.
And this right here perfectly shows one of the biggest divides in crypto. You've got assets like Bitcoin with a fixed supply, only 21 million will ever exist. That programmed scarcity is a huge driver of value. And then you have inflationary tokens, which are always creating new supply, often to reward users, but that can also create constant pressure for people to sell. Projects can also actively manage their supply with something called a token burn. And yeah, it's pretty much what it sounds like. They send a chunk of their tokens to a dead-end address, which permanently removes them from the supply. By making the tokens that are left more scarce, they can, in theory, increase their value.
Okay, now for our final and maybe the most powerful layer. The technology and the code, they're predictable. But the humans who use them, not so much. This is where logic often just goes right out the window and gets replaced by raw emotion.
And this gets us to a really crucial cycle in crypto. You've got FOMO, the fear of missing out, and it's driven by pure greed. It makes people buy at high prices because they see something rocketing up and they just can't stand to miss out. And then you have its ugly twin, panic selling. That's driven by fear, and it causes people to sell low and lock in their losses. This emotional roller coaster is where most people get hurt.
And the thing is, our own brains are basically wired with these little traps that make everything so much worse. We look for info that just confirms what we already want to believe. We get way too confident after one or two lucky trades, and we just follow the herd even when the herd is running straight off a cliff. Understanding these biases is absolutely key to not falling for them yourself.
Now, what pours jet fuel on this whole emotional fire is the speed of information. I mean, forget waiting for the 6 o'clock news. In crypto, a rumor on Twitter or a message in some Telegram group can hijack our built-in biases and send a price into orbit or into the ground in a matter of seconds. This 24/7 info flow basically weaponizes FOMO and herd behavior better than any other market on Earth.
Okay, so we've looked at the market structure, the token's code, and the psychology of the crowd. The thing to remember is that none of these exist in a vacuum. The price you see on your screen is the dynamic, real-time result of all three of these forces smashing into each other.
Think of it like this. The market structure and all its liquidity, that's the foundation. The tokenomics sets the fundamental rules of the game, and then human psychology and the lightning-fast flow of information, well, they act as this massive, unpredictable amplifier on top of everything. It's the way these three forces play together that truly discovers the price.
So what does all this mean for you? It means you can stop just reacting to price and start interpreting it. Now when you see a price spike, you can actually ask, okay, is this about the token supply? Is it just social media FOMO? Or is it a really low liquidity market? This framework helps you understand the why behind the price.
And that brings us to the real takeaway here. The goal isn't to predict every single wiggle on a chart. It's to understand the fundamental forces that are at play. Because when you stop chasing price and you start understanding it, well, you change your entire perspective on the market.